Avoid these investing mistakes. I wish someone has told me earlier. Do you know that this ETF has 99.96% negative returns? Have you ever thought that you can bet against the market and profit when the stock market crash? As a beginner, I noticed that whenever the US stock market falls that night, this particular ETF, SQQQ, will appear as the top volume play on my brokerage app. So basically, the more when the Nasdaq tech stocks falls, the bigger the profit SQQQ will generate. So I started buying SQQQ on the days when the tech stock fall. However, over time, the value of my SQQQ keeps dropping, and I even put in more funds to average and lower down my costs. In the end, the loss ran too big and I realized I was losing my sleep. I ended with a cut loss and sold all the SQQQ. So what is wrong and what is the danger of inverse ETF? First, you got to understand what actually are you buying. SQQQ is also known as ProShares Ultra Short QQQ. ProShares is the company and the provider for this ETF. QQQ is the ETF tracks the Nasdaq ETF, which consists of companies like Nvidia, Microsoft, and Apple. On its website, Ultra Short claims that it's a minus 3x ETF designed to profit when the daily price of the Nasdaq 100 index declines. How does the ETF actually works? Let's say you start with $100. On day one, the market is up 10%. You get a 30% returns, and now your $100 has gone up to $130. On day two, the stock market is down negative 30%. So 30% of $130 is $39. So the value of your investment went from $130 to now $91. And this is called decay. The daily up and down movement eats away your returns because the percentage changes work on different numbers each day. This happens daily as the fund manager rebalances the portfolio from its daily buying and selling. The more the stock market goes up and down like a roller coaster, the more your ETF loses value over time. So how can we avoid this? Let me introduce you to this website called StockSplitHistory.com. This website captures at least 10 years of the historical data, and it shows you the historical performance. Two things that we focus on. First, at the top right, once you key in SQQQ, it will show you that SQQQ has went through 7 split history. So it says on May 11, 2012, this was a 1-for-4 reverse split, meaning for each 4 shares of SQQQ that you own, the shareholder now only owns 1 share. So for example, before the reverse split, you have 1,000 shares. It will now be reduced to only 250 shares. And this is called reverse split. In short, your share quantity becomes smaller. Number 2, scroll to the bottom and you will see 2 charts. One is the split return adjusted CAGR, or the compound annual growth rate, and one is with dividends, and the other one at the bottom is without. So what we want to focus on is to see whether the returns is negative or positive. Now in this case, SQQQ had a 99.96% negative return. A $10,000 that you put 10 years ago would be worth only $4.30 today. So the question is, why would anyone buy inverse ETF? I later found that, as stated on his website, it was for professional investors or traders that would like to protect their investment when the stock market falls. But in the long run, what we know is that US stock market has relatively performed well. So it was never designed for investors to hold SQQQ for the long run, and this was a hard lesson I wish someone has told me earlier.